Welcome back, Navigators. As you might already know, the stock market isn't just about luck, it's about understanding the factors that drive returns. In this video, we'll see how to leverage the factors that hedge funds managers also use, so that you build a portfolio that's designed for success. Factor investing is an investment approach that involves targeting specific drivers or factors that have been shown to explain differences in asset returns. These factors are grounded in academic research and have been found to deliver risk-adjusted returns over time. Factors are underlying characteristics that can explain the performance of a group of securities. They are the common drivers behind the returns of assets and help investors understand why certain securities outperform or underperform others. Now, before you dismiss it as another Wall Street jargon, let me assure you, factor investing is far from complicated. It's about tilting the odds in your favor by investing in companies with specific characteristics that have historically outperformed the market. Think of it as picking stocks with a little extra something special, those key elements that make a difference. In the world of investing, these elements are called factors, and they can be the key to unlocking superior returns. So put the kettle on, sit back, and let's unravel the exciting world of factor investing together. It might just be the financial boost you've been looking for. Factor investing isn't about complicated algorithms or insider knowledge. It's simply about identifying and investing in companies that share certain characteristics or factors that have historically been linked to higher returns. Think of it like baking a cake. You wouldn't just throw in random ingredients and hope for the best, would you? You'd follow a recipe, selecting ingredients that, when combined, create a delicious treat. Factor investing is similar. We identify factors such as value, size, momentum, and quality. These factors are like our recipe, guiding us towards companies with a higher probability of success. By tilting our portfolio towards these factors, we're not just picking stocks randomly, we're making calculated decisions based on evidence and historical data. In the 1990s, Eugene Farmer and Kenneth French expanded on KPM by introducing additional factors such as size, small cap versus large cap, and value, book-to-market ratio, which became the basis for the Farmer-French three-factor model. Please review the cross-section of expected stock returns for more details. Now that we understand the basics, let's get more and more into the exciting world of factors. There are many different factors to consider, each with its own unique characteristics and potential for returns. We're looking for companies that are undervalued by the market, like a diamond in the rough. Therefore, the value factor focuses on buying undervalued securities, which are typically identified by metrics such as the price-to-earnings, PE, ratio, price-to-book, PB ratio, or dividend yield. Value investors believe that these undervalued stocks will eventually revert to their intrinsic value, offering higher returns. The momentum factor involves investing in securities that have had strong recent performance under the assumption that they will continue to perform well in the short term. Momentum can be measured by past returns over a period of 3 to 12 months. Think of it like a snowball effect. As more investors jump on board, the price continues to rise. By identifying companies with strong upward momentum, we aim to capitalize on this upward trajectory. Quality factor focuses on companies with strong fundamentals, such as high profitability, stable earnings, low debt levels, and efficient use of assets. High-quality companies are typically more resilient during economic downturns. These companies are built to last and weather market storms. Low volatility factor takes advantage of market fluctuations by investing in companies that are less volatile than the overall market. Think of it like a steady ship navigating choppy waters. These companies offer a smoother ride during turbulent times. The size factor refers to the tendency of smaller companies, small cap stocks, to outperform larger companies, large cap stocks, over time. Small cap stocks are often more volatile, but offer higher potential returns. Finally, the dividend yield factor involves selecting stocks that pay high dividends relative to their share price. Dividend-paying stocks often provide steady income and may offer downside protection. So, how can you effectively implement this specific strategy? Meet Sarah, a teaching assistant who always dreamt of early retirement. She diligently saved but realized her savings account wouldn't make her dream a reality. Discovering the factor investing strategy, she started by researching low-cost index funds that tracked specific factors like value and momentum. Take a look at ETFs, such as iShares MSCI USA Multi-Factor ETF, LRGF, Invesco S&P 500 Equal Weight ETF, RSP, Vanguard US Value Factor ETF, VFVA, or iShares Edge, MSCI Minvol USA ETF, USMV. She then allocated a portion of her savings to these funds, diversifying across different factors to manage risk. Over time, her portfolio steadily grew, outperforming the market and bringing her closer to her retirement goals. It's easy to see that factor investing is accessible to everyone, regardless of their financial background or expertise. By understanding the basics and adopting a disciplined approach, anyone can harness the power of factors to achieve their financial aspirations. Ready to start your factor investing journey? Educate yourself. Knowledge is power. Learn about different factors and their historical performance. Determine your risk tolerance. Factor investing involves risk. Choose factors that align with your goals. The selection often involves a combination of factors that are expected to complement each other. Farmer used a 3-factor model, so you can start from there. Most factor investing strategies use multi-factor models, combining several factors to diversify risk and improve potential returns. For example, a portfolio might incorporate value, momentum, and quality factors to balance growth potential with downside protection. You screen for all these 3 factors separately, rank your resulting stocks, and finally choose the top 10, usually by their momentum score. Or you can add the size factor as well, choosing smaller cap ones first, for example. Play with various combinations and find what best works for you. Use ETFs, mutual funds, or individual stocks. Start small and diversify. Don't put all your eggs in one basket. Diversify across different factors. Be patient and stay disciplined. Factor investing offers opportunities, but be aware of risks. First, factor rotations. Factors can go in and out of favor, like fashion trends. What works in one market might not in another. Stay informed and adjust your portfolio. Next, data mining bias. Historical data can be misleading. Some factors might show stellar past returns, but this could be due to chance or data mining bias. Rely on robust research screening platforms and avoid chasing fads. Then transaction costs and taxes. Trading costs and taxes can eat into returns, especially with frequent trading. Consider these costs when rebalancing. Lastly, emotional decision-making. Investing can be an emotional roller coaster. Avoid emotional reactions and seek professional advice. Despite the risks, factor investing offers several compelling benefits. First, the potential for higher returns. Historically, factors have demonstrated the potential to outperform the market over the long term. By tilting your portfolio towards these factors, you can enhance your chances of achieving your financial goals. Next, diversification benefits. Different factors tend to behave differently in various market conditions. By diversifying your portfolio across multiple factors, you can reduce overall portfolio risk and enhance potential returns. Then transparency and objectivity. Factor investing relies on data and evidence, providing a transparent and objective approach to investing. This can be particularly appealing to investors who prefer a rules-based approach over subjective stock picking. Finally, accessibility and cost-effectiveness. Factor investing is no longer limited to institutional investors. With the rise of low-cost ETFs and index funds, anyone can access factor-based strategies at an affordable price. To conclude, Navigators, factor investing isn't a get-rich-quick scheme, but a long-term strategy for building wealth. It requires patience, discipline, and a bit of know-how. Remember Sarah? Her story highlights that factor investing is achievable for everyone. By understanding the basics, managing risks, and staying committed to your plan, you can benefit from the power of factors to achieve your financial aspirations. Educate yourself, explore different factors, and start building a portfolio that aligns with your goals. Your future self will thank you for it. That's all for today. Until next time, take good care of your finances, navigators. And don't forget to subscribe and share if you found any value.